Hi everybody and welcome back to the channel. So in the TFSA we were up on Friday 3%, so up $429.90 in a single day. People were very happy to buy stocks. Past week has been pretty good. We're up 3%, so basically all the gains were made on Friday. This month we're up 6% or $900. Past 3 months we're down 3% or down $577.63. Past year we're down 7% or down $12.69, and then all time in the TFSA we're only down 3%, so only $600. So we're almost back, flat and kind of digging out of this little hole that we've been in for the past couple of months, and the market is responding well to the Bank of Canada only raising interest rates 0.5%. A lot of people were expecting 0.75, but that didn't happen. So the market kind of got the signal that, maybe these interest rates are kind of, slowing down. They're not as aggressive. They're not as high. And, maybe these increasing interest rates will stop, which is really going to help stocks, companies, and, just helping people have access to money. If they need to take out a loan, they don't have to pay as much interest. So if you want to follow along with my buys and sells, you can just subscribe to the channel, like the video, and share the video. And I'll roll the intro and get into the earnings of a couple of my holdings and my transactions for the week. And let's get into the portfolio. So Apple is in the green by 8%. And Apple had some very good earnings, and Apple stock rose a lot. And Apple beat on the top and the bottom line, so $1.29 versus $1.27 estimated. And then revenue, they beat by 90 billion versus 88.9. So the revenue overall was up 8.1% year over year, which is great. So Apple is still growing. Unlike some other companies which are slumping, like Meta, other companies that just keep guiding lower. iPhone revenues were up 9.6% year over year. So iPhone revenues still grew despite missing the estimates slightly, but that's fine. They're still growing overall. In fact, we knew about the iPhone slump when it was revealed that iPhone wasn't sending massive shipments of iPhones, but they're going to go into a better quarter. So I think the next quarter will be even better because Apple tends to do very well in the holiday season. So usually the next quarter is going to be even better than this one. And then Mac revenue is really impressive. So 11.5 versus 9.36. So this is a huge gain here. So 25% year over year. And this is especially impressive because PC demand has declined across the board about 15-20%. Yet Apple continues to grow this segment at a crazy rate. So I'm very impressed with this, and it's quite surprising, but it's very good. iPad revenue is down slightly, so a little bit less demand for this, but, an iPad is more of a, I guess, more discretionary than a Mac or a phone would be. So this is going to kind of cycle, in and out as to how many people want an iPad, but I think the iPhones and Macs are just solid. And the other products, so like their AirPods, accessories, up 9%, and they beat over there. And then services revenue missed slightly, so 19 versus 20 billion, but still grew 5%. And the most important field, their gross margin increased from 42.3% to versus the 42 expected. So the fact that we're going into rough times where companies are decreasing their profitability, Apple continues to increase their profitability. That's just incredible. So that means that they can pass on the increasing costs to customers. They can fight inflation. They can fight, a rough economy. So that's why I'm very excited. And they also said that they would increase the prices of their services in Canada as well. So Apple is increasing the cost of Apple Music, Apple TV, and Apple One in Canada. They're doing it in other regions. So it's going to increase from $1 to $3 for the base level subscription of each platform. So we can see that for Apple Music, It's going to be, for an individual, it's going to be $10.99 instead of $9.99 previous. The family plans are going to be $2 extra from $14.99 to $16.99. And the annual is up $10 for Apple Music if you want to pay, just once a year. Apple TV Plus, instead of $5.99, it's $8.99. Then annually from $60 to $89. And then Apple One is just bundling all of Apple's services together. So like their fitness, Apple Music, Apple TV, basically everything. You can pay $18.95 and get all the Apple services. And this is a great way to lock in your customers and keep them on the Apple platform and the ecosystem, because if you're used to all their services, it's going to be very hard to move away from your iPhone and iPad and other accessories. So this is going to generate Apple a lot more money, and their services revenue is their highest margin revenue. So, they don't have to build a phone. They don't have to build a product. They just essentially just make as much. They can keep most of the money they make from this segment. So that's why Apple's going to be really impressive for years to come. And this price increase I think is kind of underrated. It's definitely going to show up in the balance sheet, and you're going to notice it in the free cash flow when they're making, an extra $10-20 billion just from their services segment. And moving on in the portfolio, AQN still down, but holding up okay. ATDs actually hit a 52-week high, so broke the $60 mark that had a lot of resistance here, but it finally broke through, so we're up 7.8% here. I do want to add a little bit here, but I'm focusing on a few other positions. Aritzia is doing very well. We're up 36%. This was at about 55, but I think some people took profits off this one. So you had a couple people selling out of the position, but I'm long in this one. This isn't a short-term trade for me. I think Aritzia has a lot more room to grow, and that's why I'm not just cashing in and then putting this in a stock that's much lower. For Brookfield Asset Management, I purchased 4 more shares, going up to 20, just because they're planning to spin off their asset management business on November the 9th, and all the shareholders are going to vote for it at 11:30 a.m. on that day. So they're going to vote on whether to do the spinoff or not. So if you're a shareholder of BAM and it's approved, you're going to receive 1 share of the asset management spinoff for every 4 shares of Brookfield Asset Management you own. So that's why I bought it in 4. So I would get 5 should that happen. I mean, I'd actually prefer that it didn't happen, just because I'm planning to just sell the shares of the new spinoff and then just put it all into Brookfield Asset Management, because I want access to all of their companies, like their infrastructure business, their real estate business, their private equity business of companies you can't even invest in the public markets, and everything else that they hold. So definitely just want to hold this one for the long term. So very happy to average down at around $52. And then for Scotiabank, I just reinvested the dividend they paid me on the 27th. So they paid me a little over $22. So I just reinvested that right back into Scotiabank. And the great thing about that is it increased my passive income by about 11 cents per month, basically forever. And that's money I didn't have to put in the portfolio myself. So that felt really nice that, that I'm kind of getting help with this portfolio. I'm not just on my own. My companies are also giving me a helping hand. It's not just all my deposits. And as I grow this portfolio over time, it's going to become more and more apparent that, I have some help here and it's not all on me. And for Costco stock, it's actually finally rolled over into the green. So it's been rising. I mean, obviously, I wish I could get more, but, the market might dip again. If it goes into the 450s or the 400s, I'll definitely continue adding here. Otherwise, I'll probably just throw in like a couple bucks here and there into this, because I think it's a little bit overvalued right now. At, in the high 500s, I definitely am not going to add more to this. And then ENS has been pretty solid. So this is Enbridge. So this also rolled over into the green, just giving us a 10.5% yield on our money. So, and it's giving us income every single month, which is just helping our portfolio grow. So that's doing excellent. And then Google also announced their earnings. Not quite as impressive as Apple's, but they're still growing. So let's get into that one. And Google grew their revenues. So they went from 65 billion in this quarter last year to 69 billion, and that's a growth rate of 6%. I mean, that doesn't sound great. That sounds very slow, especially if you compare it to last year where it was 41%. But one thing you have to keep in mind is that, the pandemic forced a lot of people to stay home, so naturally a lot more people are going to watch YouTube and pay for advertising. But now, if you take a look at the constant currency, because foreign exchange is so rough on these big tech companies, they're not making as much money. Google actually grew 11%, and I actually think that's quite good because their comparables are very, very high, and they still grew despite that. So I think because of this going forward, the expectations of Google are going to be a little bit lower, and they should surprise to the upside. I think this is just not a good time for ads, and we noticed that in a couple of other ad-based companies, like where Snapchat just fell off a cliff some more. Meta keeps declining. They can't maintain their ad revenue. Their margins are coming down. Speaking of margins, Google's are declining as well, but I think that's just due to their they're not quite as efficient with their capital as a Microsoft or an Apple are. So that's one con to Google. I just don't think they're as efficient as a company, but they can improve on that. And one reason why would be they hired just way too many people. They hired about 36,000 people, I think, just in the last year or so. They definitely have to make some cost efficiencies happen and maybe cut some of those jobs. I'm not sure why there's so many hires at Google, but they have to do something about it and keep their spending in check because their margins going down is not good long term. I think they can definitely improve this and get back to 32 for sure. So I don't think this will continue trending down. And another really cool thing I noticed was that Google Cloud grew tremendously. So it went from 5 billion to 6.8. That's incredible growth for just one quarter. It's growing very fast. Only con here would be that the Google Cloud services are still not profitable. So they lost about 644 million last year, and this year they lost about 699. I think that's fine. It's a high margin business, and I don't mind them just growing that business and then eventually turning that into a profitable business segment. So that's definitely something good to look forward to. But it definitely disappointed the market. That's why Google stock fell a little bit. People were not happy, but I just think the expectations were a little bit too high. But going forward, I think 5-10 years from now, you'll be happy to buy Google at these levels. If it falls further, it's an even better deal. Moving along in the portfolio, Intel also released their earnings, and they rose a lot. They were at 25, 26. They shot up to 29 in a single day, and that's because people were happy with their earnings for once, which is great news for Intel investors. So for Intel's earnings, revenue was down in this quarter versus last year, so down 20%. But Intel's profit comes primarily, and their revenue primarily from the consumer market. So the fact that we're in kind of a cyclical decline for semiconductors and PC sales are slowing down, definitely going to hurt Intel, especially with a company with, such large market share. They're still the dominant, market share company for semiconductors. So obviously they're going to hurt a lot more than AMD will, although AMD is feeling that pain too right now. The margins are down as well. Again, not something you want to see. But you have to keep in mind that Intel's in a very, very heavy investment phase in their business as they're building up their semiconductor fabs to make computer chips for not only themselves but other clients that are going to pay them. Now, one thing I want to look at, the most important line to me is R&D and mergers and acquisitions. This is how Intel's going to grow. Primarily R&D. That was up 10% over the last quarter. So you can see even in the previous report, it was up 5.4 to 4.8, up 12%. So Intel is continually spending more and more money on research and development, and that's going to improve their products and give them that competitive edge. Because if you're spending more on research and development on your products than AMD even makes in free cash flow, I don't see how they're not going to be able to not only catch up, but become the leader again. And we're even seeing that now with the 13th generation chips that they released, that they're already ahead, and they haven't even released like their next generation stuff yet. So that's really impressive from Intel. And another major thing is that they spun off Mobileye, and that's going to be another way for Intel to get a little bit of money. So they raised a little around $800 to $900 million just from this spinoff, and essentially they only, sold off about 6%, ownership of the company. So Intel still retains most of Mobileye, and that's actually their fastest growing segment of their business. It's actually growing at around 38% in the last quarter versus 2021. So this is definitely great for Intel. $800, $900 billion. They could definitely use the cash flow to invest in the business now, help pay for that research and development, help pay for good talent. And you have to remember that, they're getting $20 billion from the CHIPS side. They're getting $30 billion of funding from Brookfield Asset Management, another holding that I have. They are very interested in having, an ownership stake of the fab plants. So that really makes me confident about the investment long term, even though the stock is down in the short term. I plan to hold this for many, many years and just collect the dividend along the way. And then eventually the business is going to recover, and it's going to, I think I'll be very pleased with the investment. It looks a little foolish right now if you're just looking at the results. But you also have to notice that the shares just surged. So after the earnings report, Intel surged 10% in a single day. So people were very happy with that earnings report, extremely happy. And, they beat the expectations. They beat the expectations of not only revenue, but also profitability. And they also stated that they would improve their profitability by around, they're going to cost cut about $3 to $10 billion on the company. So they're going to, make some efficiencies, maybe fire some employees, but that's also going to help their bottom line as well. So, they definitely know that they can definitely make the company more efficient, and that's definitely great news for investors. So by around 2025, they predict that they'll save about $3 billion to $10 billion in costs, and that's going to help create value for the shareholder. And then moving along with Microsoft, they also reported their earnings, and they beat on the top line and the bottom line. Investors weren't super happy with the report, but actually I was, so let's get into that. So the revenue increased 11% for Microsoft. If not for foreign exchange and the weak dollars, outside the US dollar, because, Microsoft is an international company, they earn money all over the world, they would have grown 16%, which is, I think, a very good growth rate for a company of this size. It's very impressive that they can grow that quickly. And if not for the currency exchange, 16% is great. There's nothing wrong with that at all. And if we look at all of their segments overall, we can see that Microsoft Azure grew 35%, despite the currency, the currency risk that they have, and it's just not going their way because the rest of the world isn't doing so great economically. But if you include that, it was 42%. So that's very fast growth. You can even see other many segments of their business are growing. Like LinkedIn is growing 17%. The Windows OEM is actually down. It's like one of the few things that are down for the company. But if you think about it, it actually makes total sense, because if there's less PC demand, if you don't buy a computer, you don't need a Windows license. So that makes sense as to why their sales would decline by around that much. But I think when that cycle turns around, Microsoft will definitely gain from that. Similar to their Xbox like gaming division. So once the cycle improves, that's going to start growing again. So we're just in a down cycle here, but you can just see the strength of their business overall. Like every segment is growing by double digits pretty much. So this is a great company, and I'm not worried at all. In fact, if the price, fell, to 200 or lower, I'd be very happy. I'd be buying shares very happily at that price. And the last stock I purchased was TELUS. So this was actually in the red, but now we can see that it's, rolled over in the green just slightly. So if we include dividends, I'm actually quite in the green on this position because I've held it for, over a year and a half. And the dividends have come in no matter what, and whenever this one falls, I'm more than happy to purchase more shares of this company just because of their fantastic dividend growth and the diversity of their business, and just the fact that they're not just a telecoms play, like they're in agriculture, healthcare, you name it, they're definitely in there, and they have a lot more growth potential than Rogers and Bell will have. And then TD Bank is down a little bit. I'm actually expecting about a $16 dividend from this on the 31st. So that'll definitely be a nice Halloween gift. I'll buy some candies, or just reinvest it back into the stock, and then we'll just get more dividends. So definitely going to plan to do that here. And then for Tesla, I just made a little bit of a buy with just the couple of dollars I had left. So about 4% of a share, just averaging down on this position. I think this is just a great time to add to this position, just bit by bit. It could definitely fall a lot, and that's why I'm not just, going out and buying and doubling down on this. If it fell below 200, I definitely feel confident and go for it, but just because I'm a little wary of the valuation. It is growing very quickly, but there is downside risk if they don't meet those goals that the market expects. So definitely going to be patient on this one and just average in a little bit slowly over time. And for the dividends earned all time, we've earned $861.69 in dividends since starting in the portfolio. Our annual dividends have increased from our last update, so they went from $883.88 to $890.44. So that's an increase of about $6, not bad there. Monthly, we're making $74.20 instead of $73.66. And about 11 cents of this income is just from that reinvested dividend from Scotiabank. So I'm definitely noticing that little snowball starting to form, that I'm getting 11 cents in income per month. And I didn't have to make a deposit to do that. This is while, I'm only depositing, maybe twice a month, about $200, $250, however much I can, and just averaging in. So it's really nice when these dividends come in and just kind of help me increase that income. And that's definitely going to be more noticeable as I go on in the portfolio, when my deposits aren't going to be as meaningful and my dividends are going to be way more meaningful and pulling in a lot of the weight. But right now, it's still the majority of it is still my effort and my deposits. So I just have to keep consistently investing and averaging in just every month, no matter where the prices go. Just try to get the best value that I can. And if I can't, just buy solid quality, and it'll even out over time. And then the weekly average, we went up 12 cents from $17 a week to $17.12. And then daily, we went from $2.42 to $2.44, so an extra 2 cents a day just from our little buy. Brookfield doesn't give a very high dividends. That's not really why I'm buying it. I mean, it does pay a dividend, which is nice, and they grow it. But I just think the overall total return of it is going to be very good. So that's why our passive income didn't really grow that much with this week. But I definitely plan on improving that in the next deposit and focusing maybe a little bit more on higher yielding stocks. And then the months to earn $100, I'm keeping track of the compounding. So this is how long it takes me to earn $100 in dividends. So 1.36 months, and now it's down to 1.35. So this number continues to shrink as I continue investing. And then hourly wage, our portfolio got a raise at work from the market. So if I were to work a 40-hour work week, it makes 43 cents an hour, and that's doing absolutely nothing on my end. I'm earning my own income actively working, and then my portfolio is on the side earning additional money for me, and that amount continues to grow. And one thing I want to note, just from this October of 2022 to last year, so far we're up to 84.34. I'm also expecting $16 from TD, so we might be hitting $100 this month. And if we compare that to 2021, I earned $38.75. So I've earned more than double. Well, almost triple if we actually hit 100 in just 1 year of investing. That's actually incredible that you can have this kind of progress. And that's why it's important to, track your charts, track how you're doing, because this is actually very motivating, seeing this progression of growth over time as our income just continues to rise and rise in a very predictable fashion, even though the market isn't, going up. So it's definitely a great time to invest. And if you aren't investing already, feel free to use my link for WealthSimple in the description below, so you can get the value of up to $3,000 just for signing up and making a deposit. And then our portfolio yield is at 4.67%. I definitely want to get this up over 5%, so that's why my next few deposits, I'm probably going to buy some more Algonquins, some Canadian banks, just some higher yielding stocks, try to get this number up to 5%, because that's just, you know, a number that I like. I feel like it's not really yield chasing, especially in Canada, since a lot of banks and pipelines and even telecoms are paying around that much yield. So if you watch the entire video, don't forget to subscribe, like the video, share the video, and have a great day, everybody.